Commodity volatility reigns supreme. India suspended cotton exports, and though prices rose immediately after, reports indicate long-term prices shouldn't spike because global production outside India is increasing. Regular gasoline and on-highway diesel prices are continuing to rise. The Midwest diesel price currently hovers near $4 per gallon. Crude oil is roughly 7 times the price of natural gas in the US, and that's why companies like GM and Chesapeake are trying to take advantage of the supply glut of natural gas by continuing to develop natural gas vehicles. Gold is trading around the psychologically important benchmark of $1,700 per ounce, putting the gold-silver ratio around 50. The euro has strengthened against the dollar over the past month. This trend may continue as the EU agreed to a solid Greek debt deal, but we are still paying very close attention to the situation in Europe. Look to recent signals from China to inform your sourcing strategies. Beijing reduced its GDP growth target to 7.5%, the first time the target dropped below 8% in 7 years. As a result, Chinese steel companies may reduce output. Chinese auto sales have dropped 24% year-over-year in January, the worst drop in 7 years. Back in the US market, the ISM reported a PMI of 52.4 in February, indicating that manufacturing continues to expand. But the overall PMI decreased 1.7% from January to February. The new orders index was also down, but continues to grow as well. New unemployment claims remain well below the 400,000 recessionary threshold, and both residential starts and non-residential construction starts are in growth territory. Taking a look at steel, U.S. steel production is again approaching 2 million tons per week, on par with historic norms. The 3-month moving average of durable goods orders increased year-over-year at a healthy 4.9% in January. Hot-rolled and cold-rolled coil prices have both increased by about 3% since the beginning of the year, but have begun to slip these past 2 weeks. Meanwhile, Goldman Sachs sees iron ore prices at an average of $150 a ton for the remainder of the year. Looking at stainless, we haven't seen anyone call for serious price drops for iron ore, coking coal, or scrap. The ferrochrome market remains bullish in the medium to long term as well, yet the nickel market remains in oversupply. However, due to lower than average inventory levels, we may see a slight drift upward in stainless prices. Recently, MetalMiner reported that the copper market is in better balance than expected. The forward curve is in healthy contango, suggesting a market adequately supplied with metal, and no one is expecting a sudden surge in demand to unsettle that position anytime soon. In HSBC's view, copper should remain at current levels of around $8,500 per ton. Aluminum is technically no longer in a bull market, according to our friends at Harbor Aluminum, and their tactical signal has changed from buy to neutral. Prices now seem to be set for testing support around $2,200 to $2,150 per metric ton, but Harbor predicts prices will still inch up during Q2 and end up at $2,600 a ton by year-end. This month, we sat down with Omar Abdullah, co-founder and managing director of the Smart Cube, to get his insights on commodity forecasting. The Smart Cube provides customized business and investment research, as well as marketing and data analytics solutions to leading corporations and professional services firms worldwide. Well, Omar, thank you so much for joining us today. What are you seeing in terms of the biggest challenges and struggles manufacturers are facing? And then give us a glimpse of what companies are doing from a forecasting perspective.
Sure. So first of all, thanks, Lisa, for having me here. We really appreciate the opportunity. As I sort of look at where manufacturers are and where, let's call it, their larger environment is headed, I think probably the key issue on their minds these days is just this broad topic of uncertainty. And uncertainty equating to volatility, which is really what the issue is here. And what we've seen over the last several years for various reasons, whether it's because of macro events such as the tsunami or an earthquake or whatever else it might be, or whether it's quote-unquote man-made events like the financial crisis that we went through, all of that uncertainty translates very directly into volatility around the ability to predict where business is going, to predict where manufacturing is headed, and more tactically, to predict where prices are headed for key commodities that they're looking to buy. And that's really the fundamental problem that we have here. And as a result of that, it throws out of whack all of your business plans, your forecasts, your margins, and cost levels related to that. This whole topic of forecasting is becoming more and more relevant and pivotal to the strategic discussion that supply chain and procurement executives need to be dealing with these days. What a lot of progressive procurement professionals are doing, progressive forecasters, if you will, they're looking at forecasting as modeling a set of variables and really trying to understand what those variables are that influence the price of a particular commodity, and then ensure that that's rigorously tested against available data and information that's out there, corrected for various events that might take place and projected events that might take place, and then build out a forecast. So it sounds very complicated, and it's a little bit technical in terms of what's there, but fundamentally, here's what forecasting is really evolving to. It's about fundamentally understanding the commodity that you've got. So let's say if you're dealing with a commodity like crude palm oil, right? Very popular commodity because of its high yield that it has relative to other similar commodities that organizations might want to use. There's a host of factors that play in. It's influenced not only by production levels in Indonesia and Malaysia, which together comprise 87% of world production in 2010. I think that's about right, what the number is. But it's also influenced by import volumes from India, from China, from the EU, obviously usage in Indonesia and Malaysia. But and then thirdly, it's also influenced by substitutes like soybean oil, which is probably the closest commodity to swap it out with. And so when you model what's happening with crude palm oil, you start looking at a whole set of variables. Malaysian GDP, what's happening to the Indonesian economy, what's happening to currency rates, what's happening to import levels and end user demand in specific industries in India and China, and why they're going to be used. And a host of factors such as that. You identify those variables, you model those variables, you conduct a whole range of tests. And there's a slew of tests that are out there, from ANOVA to goodness of fit to heteroskedasticity, I always get that one slightly wrong, and a host of multicollinearity, a whole factors like that, which allow you to think through what the variables are and really distill them down to say, here's what my quote-unquote equation is, my model that I'm using to forecast prices. But then you have to look at that model in light of the economic environment. Well, if you're in a growth environment, the model might look one particular way and include certain variables. If you're in a slow growth environment like we are in right now, it's a different equation, and different factors tend to play in. And we've seen this through our analyses in actual examples of various commodities that are out there.
Right, great. I mean, that's very helpful. Do you see, and from your experience, do you see certain industries that tend to be more advanced on this continuum, if you will, or?
I don't think it's necessarily industry-centric. I think it's cross-industry. I think we tend to see it more, it's probably more segmented by organization. Certainly the larger the organization, the more that they have at stake, and therefore the more they're willing to invest in, from a resource perspective, whether internal or external, into building better forecasts and closely monitoring what's going on in a particular market. So I think there's certainly a company segmentation aspect of it. But I think more fundamental to that is simply how critical is this commodity to your end product that you're making? How relevant is it to your value chain? I mean, there's CPG companies out there for whom palm oil represents a small fraction of the actual end unit cost. But because of the volatilities in palm oil over the last couple of years, it can be a bottleneck commodity, if I can use that term, and therefore it's very critical. So I'm not sure it's so much industry-centric. I mean, certainly, you'll see it in the metals industry. CPG is big and looking at a lot of these factors for the right reasons, for obvious reasons. And CPG clearly encompasses a whole slew of subsectors within that. And then pharmaceuticals also it's a very, very critical area for them to look at.
Okay, so one additional follow-up question, which is, okay, so you're a company, you've built out these sophisticated forecasts. Let's say you have you've divided it out by scenarios, let's say, likely, least likely, whatever. What are you doing with it afterwards? What are you seeing companies do with the forecast? How are they changing the behavior on the buying side?
So what forecasting allows you to do is to really get a better handle on aspects such as fundamentally, how confident am I in terms of where prices are headed? And if I can do that, I've got better options from a hedging perspective, right? In terms of how I can react to it from a strategy point of view. A solid, rigorous forecast allows you to better plan out your purchasing cycles and make better strategy decisions in terms of what I'm going to buy and when I'm going to buy them, and how much inventory I need to keep, natural hedging versus any sort of financial hedge that I may need to undertake. Forecasts give you opportunities to tap into and understand leading indicators. So to go back to my palm oil example, the Malaysian GDP, turns out, is a bit of a leading indicator in terms of where palm oil prices are headed. It's not the only indicator, but it's one of the leading indicators. So it allows you to pick out one or two key variables that you as a procurement professional should keep track of on an ongoing basis, right? Without having to run the whole model every single time. Now, the models do need to get rerun. So if I were to have built a model in Q1 of 2011, forecasting prices out into 2012, right? Which I think is a reasonable period to look out into 2013, 2014, who knows where things are going to go. So if I were to forecast that out, that model, that specific equation that I used at that time needs to be rethought and reevaluated in Q2 and Q3 and Q4. That's just the nature of the game. That's just how it's done. So you get different strategies that basically allow you to better plan your purchasing, to allow you to make better decisions from a hedging point of view, and really to pick out specific aspects that you want to monitor in a particular economy or in a particular, let's call it a value chain element that impacts your forecast that you need to stay on top of as a leading indicator, if you will. So better information, better clarity about where things are going, and just being able to make a better decision in terms of how I'm going to react.